Hey finance fam, welcome back to my channel. In today's video, I am going to pick a bone with dividends. Maybe not so much dividends on its own as a concept, but I'm going to pick a bone with the idea that investors feel like to be successful and to have high returns, they need to be investing in dividend stocks. There are a lot of nuances and reasons as to why you might not want to be investing in dividend stocks, at least for all of your assets. If we move over to Twitter slash X slash whatever you want to call it, we can just type in the term dividend into the search bar and see how many accounts are really focusing on dividends. Dividend growth investor, dividend hero, dividend growth hustler, dividend seeker, dividend dominator, all of these different types of accounts that really focus on kind of put dividend investing on a pedestal, so to speak. Let's get into the first reason why you might not want to be investing in only dividend stocks. Simply put, they do not have the same returns as growth stocks or maybe some other types of stocks. I actually wrote about this in the Daily Doe, busting the myth why dividend stocks fall short in returns. I basically compared two popular ETFs just to give this just a simple visual. I compared a information technology ETF, which typically is going to invest in, your higher growth companies, and a lot of them don't pay dividends. And then I compared this against the Vanguard value ETF, which value stocks typically are going to be more likely to pay dividends. And you can clearly see the difference between the dividend yield. The tech ETF is a dividend yield of under 1%, and the value ETF is a dividend yield of almost 3%. So, definitely a big differential in dividend yield there that reflects the types of stocks that these ETFs hold, which give us kind of a good comparison. So, you can clearly see that the technology stock that pays a lower dividend yield and has less dividend paying stocks is going to provide a much higher return over time versus the value ETF, which is going to be more likely to have more dividend paying stocks in it. So I don't want people to think that dividend stocks equal high returns and the returns are going to be so great and get you to your goals. Dividend stocks typically do not perform as well as growth stocks. Now, really, what it comes down to there is not should I invest in dividend stocks or not? It's what's my risk tolerance? How much risk am I looking to take on with my investing? Because when we look at the risk between a tech stock ETF, and a value ETF, these are going to have very different risk profiles, and the volatility in a ETF that focuses in growth stocks is going to be much higher than the volatility in a value ETF or dividend paying stocks. So you should really be asking yourself not so much about, returns, but think about your risk tolerance first. And if you don't like to take on a lot of risk, then those dividend paying stocks are going to probably be more stable for you, but they're not going to have the return profile that other stocks that maybe don't pay dividends have. Another reason to maybe not invest in dividend stocks would be that the dividend is a cash payment to a shareholder. So, what happens when that cash is paid out to a shareholder, that is cash in the shareholder's pocket and cash that the company does not have anymore. So, essentially, they have less cash on their balance sheet as a corporation. Therefore, their stock price adjusts every time that dividend is going to be paid out to account for less cash on the balance sheet. So think about this as like a push and pull here, right? You've got the dividend that gets paid out, the stock price adjusts down lower because that's less cash on the company's balance sheet. And so you kind of can have stagnant price returns if a company is not continuing to grow and they're paying out a dividend. So that's the combination for disaster. We do not want to see dividend stocks that are paying out dividends and not growing revenue. That equals stagnant, flat price returns. A good example of how this can actually turn out is you have a company like AT&T. AT&T pays out a dividend, but if you look at the price returns, they're very muted over the past 5 years. So, this is what can happen when you have a company that's paying out dividends, but the company's not really growing revenue very fast, and it's not really growing profitability very quickly, and there's just not really much to get excited about, so shareholders don't really bid the price of the stock up. And we have this kind of flat, choppy price action that just leads to, suboptimal returns compared to other things like the S&P 500, for example. Let's compare the actual S&P 500 index returns over the past 5 years versus AT&T, which is a dividend paying stock that is very popular and a lot of people love. But hey, guess what? I'd rather be invested in the S&P 500 in this case. Screw the dividend, the high yield that AT&T is paying shareholders. I don't care. I want the returns. So this is a really good example of how that can work against you if you're invested in the wrong types of dividend stocks. Let's take this even further. So I did a scan in YCharts to pull up dividend paying stocks that pay from 4% to 10% yield. That's kind of considered high yield. 10% is going to be considered like a high yield dividend stock. And what I did was I broke down the returns over the past 5 years annualized, and I put in what industry these stocks are in. And right off the bat, you can see that, sorting this from high dividend yield to lower dividend yield, there are a few names on here that stand out to me. Altria Group is a tobacco company. They also own a lot of popular wine brands. So Altria, the ticker is MO, it's got an almost 10% dividend yield. Sounds great. But then you look at the 5-year returns and not so great. Very flat and slightly down in terms of returns. So this is a dividend stock that's in a lot. I repeat, this is a dividend stock that's in a lot of high yield dividend ETFs that a lot of dividend investors seek out because they think that the dividend investing is the best thing in the world. So you have to be very careful what holdings are in your dividend ETF. This is another one, B&G Foods. They actually own a lot of very popular prepackaged brands in the grocery store. Think of your Green Giant, your Crisco, and a few other very, very popular brands. So this is a company that's paying an over 9% dividend yield, which is considered high, and its 5-year returns are negative 14.6%, right? Not so hot. So chasing that high dividend yield does really no good for you here in this case because this is a company that's not necessarily performing. Another one that stands out is Kohl's Corporation. High dividend yield, terrible 5-year performance, over 17% negative returns. Not great. Xerox Holding is another one. Foot Locker, popular one. And here we go, Verizon. Verizon is a similar story to AT&T, very similar story. High dividend yield, not a lot of growth in the company, negative returns over the past 5 years. Now, if you go back 10 years, 20 years, sure, there's going to be returns, but returns compared to the S&P 500 are probably not going to look that great. I just sorted this by positive annualized returns, and we can see that there's plenty of these names that have positive returns over the past 5 years and high dividend yields as well. So this is definitely a sweet spot that you want to be in if you're investing in dividend stocks. But the real moral of the story here is dividend stock investing can be a trap. You have to be very careful. There are a lot of value traps along the way. You think you're buying a really good company, paying a high dividend, it's a well-known name, and sure enough, the returns end up being not as good as you expected. Then you're not reaching your goals. You're too overly invested in dividend paying stocks. So there's a selection process that needs to be done with dividend paying stocks. You don't want to be going for high yield dividend paying stocks for everything because that could mean that the underlying company is not performing very well, and that is why the dividend is so high. Because stock price and dividend yield, it's an inverse relation. As stock price goes down, dividend yields go up. So you have to keep that in mind. The last reason why you might not want to be investing in dividend stocks, or at least investing in dividend stocks in a taxable brokerage account, tax considerations. So, if you are trying to keep your income below a certain level, if you're investing in a retirement account, this doesn't apply because these are tax deferred or tax advantage accounts. You don't have to deal with taxation on that. But if you're investing in dividend stocks within a taxable brokerage account, those dividends are being taxed every single year. Now, there's a benefit to having dividend stocks in a taxable brokerage account because qualified dividends are taxed at long term capital gains rates, which are preferred tax rates. It's going to be lower. So that's a good thing. But the bad part of that is if you have a lot of capital, this could change your income in a way that could take certain credits, tax credits, or tax deductions away from you. So you really have to make sure that you're not towing an income line that could end up having you have a higher tax bill or lose out on a benefit because you got these dividends and it bumped your income up. So that is something that everybody needs to be considering when they are investing in dividend paying stocks. So that's my beef. I'm not saying that dividend stocks are bad. They absolutely can be great. Being paid a dividend while a company is trying to change a strategy or grow in a certain way or expand internationally could be a great thing. And it's simply not all about how can you invest in the highest yielding dividend stocks. It's just not. That's not going to necessarily equate to the returns that you're looking for. All right, finance fam, if you found this helpful, please smash the like button and subscribe to my channel if you're not subscribed. Why are you not subscribed? I'll see you next time.